How are we doing? It is Friday, and the markets are continuing on this kind of downward trajectory here. We're well off the lows of the day. Markets kind of been all over the place on the downside, obviously. If you guys can hear me and see me, please let me know. I know I have my chat fixed today, so I can respond. So I'm looking in here. Hey, I see all you guys in there. If you can just let me know if it sounds and looks okay, that would be great. Anybody a Hoosier, by the way? I'm my fourth kid going through there right now. So I got a lot invested. Thank you, Steve. Got a lot invested there at IU. So yeah, the good news is bad news scenario is kind of back right now. What do I mean by that? Jobs report came out this morning. Very, very strong number. Better than expected. Much better than expected. Awesome, Z. Awesome. Um, Unemployment ticked down 4.2 to 4.1%. So, in reality, those are all good things, right? More people working, unemployment is lower. However, for the markets and for the Fed, what that does is say, okay, boy, the economy is remaining really strong. We're cruising along here. There's no need to cut rates. So that is what the market took from the jobs report this morning, that the Fed does not need to cut rates, and maybe they shouldn't have cut at the last meeting. Okay, so we're seeing, and let me see where we are live right now. The 10-year, which we talk about that all the time, the 10-year yield is what all of our loans are really based off of, even though you might get a 30-year mortgage. Everything's really based off of the 10-year. That's kind of the reference point. Before the Fed started cutting rates 4 months ago, whatever it was, that first rate cut, 10-year was at 3.6%. It almost hit 4.8% this morning. I know it's backed off a little bit, and I'm looking up here on my screen trying to get what the live where it is right now. 4.75. There we are. 4.75 after almost hitting 4.8 this morning. Okay. I do higher rates. Why is that? You know, um, fight with the market? Why doesn't the market really like higher rates? Well, a couple reasons. A, higher borrowing costs for companies affect their bottom line. But B, okay, if you know that you can go out and get 5%, 5.5% on a 20 excuse me, 20-year T-bill, whatever it is, you may look at that and say, man, I know the S&P, last couple of years returned 20 plus percent. What is the probability of that moving forward? I'm going to shift some money and lock in with no risk those rates. So it increases the competition for where that investment money goes. The higher the rates go, more money typically is going to come out of the stock market and into that safer bond market. So that's what we are really fighting with, or what the market is fighting with right now. Does that make sense? Well, that goes hand in hand. Let's see. Quasar Markets Live. Maybe it's Howard. Hopefully, somewhere there. Yeah. As rates go up, the dollar's going up. DXY. The dollar is so unbelievably expensive compared to pretty much every other currency in the world. There's no question. There's no question about that. All right. That's my spiel for what's going on in the market today. Let's dive in. Let's pick up or continue our conversation that we have had this week, right? Implied volatility. Okay. We've talked about it. We know that Implied volatility tells us how cheap, how expensive an option is. Okay. And for the most part, that's good enough. Okay. Most traders, if they understand that, okay, that's good enough. But what does it actually mean? What does it actually mean in terms of movement going forward? And how do we calculate it? Okay. I like to try and present and explain everything in a manner that you can kind of close your eyes and visualize a concept, a strategy, whatever it is. So let's take a dive into that. And before I do that, most importantly, again, let's just, let's just keep our prayers, our hopes, and our wishes for all the people affected by the fires in California. Um, Seems like things are maybe getting a little bit better right now, but better in just a catastrophic situation. Who knows what that really means? So let's keep let's keep thinking about those people and what we might be able to do to help them. Okay, implied vow. What does it actually mean? Okay, so we always talk about that bell curve. Okay. And this bell curve here, okay, that's what this is. And we've talked about it before, but as a quick review, maybe when you were in college or one of your kids was in college and the professor said, we're going to curve your grade, right? We're going to curve your grade. Well, what did that actually mean? Okay. In terms of probability, statistics, what does that actually mean? Well, the bell curve, okay, if you look at this 68%, that is all the data that's really underneath the curve here. That is also known as one standard deviation. Okay. One standard deviation. So implied volatility in the market refers to how much the market is predicting that a stock is going to move away from where it is right now over the next year. And the way that options are priced, the way the Black Scholes option pricing model is put together, is calculated. Okay. You don't ever have to know the math behind Black Scholes option pricing model. You really should know the inputs that go into it that make it tick. You don't have to know the model. The way that options are priced, mathematically, we look at that one standard deviation range. Okay. Everybody with me here? Does everybody understand the bell curve? Now, what I put on this graph here is not just the one standard deviation, which is 68% probability, but if we were to go out two standard deviations, okay, if we were to go out two standard deviations, now we're looking at 95%. So, why is that important? And why is that important for what we do trading wise? How many of you, how many of you have seen ads for other gurus or programs, whatever it is out there, where they tell you, yep, we got a 90% win rate. Greatest trader in the world. We got 90% win rate. How many of you have seen that? Okay. I'm sure probably all of you. Okay. Sure. I can give you a 90% win rate easily. I can start trading like that this afternoon. Okay. I can put on trades that are going to be successful to standard deviations 95% of the time. Okay. But what happens the other 5% of the time? Those losses blow out the wins from the 90 or 95%. Okay. So when someone tells you what their win probability is, take that under advisement. Okay. Take that under advisement. Okay. Now, if we compare volatility, okay, we know, as we said, the higher the implied volatility, the more expensive those options are. Here's a graph that kind of compares those. Okay. In a low volatility environment, you have very little variance. But in that higher volatility environment, you've got that spread out. So if we compare, and we're going to do that right now, if we compare option pricing low and high vol, option prices will always be higher on the blue graph here on the high vol. Okay. Here's just another way of looking at it. The higher the implied volatility, the more premium, the more extrinsic value. Excuse me. Remember, the intrinsic value of an option, okay, is irrelevant to where implied volatility is. Because whether implied vol is all the way up here or down here, the intrinsic value is just measures how much that option would be worth at expiration. Well, we know at expiration, every option is worth two things: either zero because it's out of the money, or if it's in the money, it's worth that intrinsic value. It's the extrinsic value, the added value that goes up as implied vol goes up. Oh, let's take a look at this. And I just put this together over the last half an hour or so. So you'll see here in this example, I'm using NVIDIA. This is literally from about a half an hour ago when it was trading 135.65. Right now, live, it's trading almost 137. Okay. Can everybody see this slide? Okay, great. So, what implied volatility actually measures is how much the market is expecting that asset class, that stock, to move in the next year. In the next year. Okay. So if we actually do the math, and this is what I wanted to do for you, so you could hopefully get a grasp and actually just kind of visualize why option prices go up when vol goes up and why they come down when vol goes down. So if we take the current stock price, which in NVIDIA was 135.65, and we take the current implied vol, which at the time I did this was 45.25%. If we multiply the stock price by the implied volatility, we get $61.38. Easy enough. What that is telling us right there is right here, right now, current market conditions with implied volatility trading 45%, the market is pricing in that NVIDIA is going to move 61 bucks. I'm just rounding out. Okay. Now, remember, that is with a one standard deviation probability or 68% probability. Okay. We have our expected move. From that, we get our expected range. If we take 135.65 plus and minus that $61, we get 74 up to 197. What that tells us is if I'm targeting NVIDIA to move lower and I want to have a position on for a year, I'm going to be looking at that 74 range. If I'm targeting NVIDIA to move higher and I'm going to have that position on for a year, I'm going to be targeting 197 range. Okay. So remember, implied volatility gives us a calculation of an expected range for 1 year. Does everybody understand that? Okay, now, why is understanding an implied volatility chart so imperative? Let me bring in live chart here. Okay, this is NVIDIA as we speak. Okay, let's look at the implied vol in NVIDIA. Okay, here is that current 45% implied vol. What if what if NVIDIA was trading down towards the low end of the range, down here? So let's call it 35%. Okay. Why is that important? Or, like, just as importantly, if it's trading up at the high end of the range up here at 55 or so, why is that important? Well, let's go through that math again to look at the difference of what it actually means. So if Nvidia was trading back down towards the low end of the range, volatility wise, okay, now what the implied volatility is suggesting to us is that 1 year expected range, the expected move is not 61 bucks, it's only $47. So that range has narrowed. That range has narrowed. Well, if the expectation is that that stock is going to trade in a more limited range, we can refer right back to this other slide right here. If we have a more limited range, lower IV, less expensive options. If we have that bigger range, higher IV, more expensive options. Okay, does that concept make sense to you? Okay. If something is expected to be in a wider range, people are going to pay more for the chance or the opportunity that the stock is going to trade in a wider range. Narrower, we're going to pay less. Okay, good. Good. Got more to do. But let's go to the wheel here, guys. And you'll see in a moment why I have those miscellaneous letters up there for today's wheel. Okay. Squirt. SQRT. No, it's not the squirt soda drink, which actually is a fantastic mixer for cocktails. If you like a vodka or something that uses a mixer in it, I love using squirt. But we're gonna figure out in just a moment here what that squirt is all about. Oh, Robert Kent, man, you're spoiling the surprise for me. No, that's really good. Anthony, nice. Nice, nice, nice. All right, let's get back to our presentation here. Okay, so real easy to calculate just looking at the implied vol, what it means is the expected move over 1 year. Okay, but how often do we put a position on? Okay, how often do we put a position on? We're we're going out a year. Almost never. I mean, maybe you do in some of your other trading, and that's fine. Almost never. So, what if we want to figure out the expected move for next week's expiration, 2 weeks from now, or a month from now, or 6 months from now, right? How do we do that? How do we do that? Well, similar, but it's a little different mathematics behind it. We still take our stock price, we still take our implied volatility, okay, and we multiply those. just as we did right here. All we did was take stock price times implied volatility. That gave us the expected move for 1 year. But for a shorter time frame, what we then have to do, what we then have to do is take the amount of days left to expiration. And this is an important one. It's calendar days. It's not trading days. Okay? In a calendar, we have 365 days a year or 366 on a leap year. There's typically 260-ish trading days in a year. Big difference in the mathematical calculations for theoretical values. So here we are taking calendar days. Why? What did we say about options because of the extra day yesterday? The extra day off, the extra holiday. Okay. Theta, the Greeks don't stop because it's a holiday or a weekend when the markets aren't open. Okay. Options don't know that the market's not open. That's why we must use calendar days. So in this example here, let's say we want to figure out the expected range. Okay. The expected range or the expected move for NVIDIA. Same thing here, 135.65, same price, same implied vol. But now we only want to go out a week, 7 calendar days. Okay. We start off with the same calculation, stock price times implied volatility. But now we need the square root of 7 divided by 365. Okay, I already did the math for you here. The square root of 7 divided by 365 is 0.01918. Excuse me. Excuse me. 7 divided by 365 is 0.01918. We then take the square root of that, multiply that out here, and that gives us the expected range for next week, 7 calendar days, $8.40. The expected move. Excuse me. I keep saying that. The expected move. So now for next week, if the stock was 135, you got an $8.50 move. Now you're looking for next week. I'm just rounding this off right here. That calculation works for any expiration. Okay. So here's an example going out to March. March is 70 calendar days. Now, if we look at NVIDIA, let me pull in live chart here. In NVIDIA, for whatever reason, probably has to do with earnings, which I know it does. Where did you go? Where did you go? Where did you go? Hang on. You are right here. Okay. The implied vol in March is higher than where it is right now. So if I'm looking at right here, 135 where we're trading, the implied vol is higher. That is the implied vol calculation I need to use here. Okay. So that's why I'm using 53% in my calculation here. Do the same thing. Stock price times implied vol times the square root, okay, is 31.48. So the expected move going out to March, 31.48. Okay, why is this important? This is not just a math lesson, folks, here. I'm not here to give you a math lesson. I'm not a math teacher, though I love math. Okay. It goes right into the explanation of why we want to sell option premium when implied vol is up here and why we want to buy it when it's down here. When it's up here and options are priced more expensively and we have the opportunity to collect more money by selling it, that's because the expected range, because volatility is higher, is a curve maybe more like this. But what happens as implied volatility reverts back to its mean? Remember, implied volatility is always mean reverting. As the vol comes down, what happens? We start to get a curve like this, where now the expectation is for a much narrower range. So it made what we sold, those outliers, okay, really expensive because as the vol contracts, there is much less probability of the stock moving those outliers. Does that make sense, everybody? Does that make sense? Okay, excellent. Excellent, excellent. So, whether you think of today's word of the day as squirt, like the soda that I said is so good as a mixer with a beverage, or as square root, or whatever you want to call it, that's the word of the day. All right. Any questions on any of this, anybody? Okay. Sometimes I hesitate. I hesitate. You can come in. Sometimes I hesitate bringing in the mathematical side of things because I don't want to scare people away. People get scared at the unknown. People get scared at, oh, come on. I don't need to know that. Just give me the answer, right? I don't need to know why we get there. Just give me the answer. The analogy I use, okay, is I love making smoothies. I love making smoothies. So I gather my yogurt and bananas and strawberries and granola, whatever else, milk that I put in there. Okay. So I know all my ingredients. Okay. Put them into the blender. When I turn the blender on and it does its thing, I don't know what the heck's going on in there. I just know I get my end result. Great. Great. And that's fine. If you're trading options, though, you're trading, you need or you should understand why something happens. How do we get from those ingredients to my final result here? You don't need to know all the long-winded math, but you have to know the process to really help you visualize how to maximize your trade. Sanaz, yes, yes. Let me bring that in here. That's a great. Clive, I will. Let me answer this one here. Sanaz said, when vol is mean reverting, you mean it goes back to a normal distribution? Yes. Let's take a Sanaz. Give me any stock you want to look at or an index. S&P's, Q's, a stock. What can I put up on the board here? Any stock you want. Sanaz, what do we got? Otherwise, I'm just going to pick one myself because it ain't going to matter. Ionic. There we go, Alan. Alan, we're on that ionic trail, aren't we? Let's go. Let's go. Let's go. Let's go. Okay. Here is 2-year implied volatility chart in ionic. When it's up here, we know it's coming down. When it's down here, we know it's going up, and it is going to find its normal distribution or its mean. We don't always know exactly when that's going to happen, but we do know with 100% certainty it will happen. Someone else just asked me to put in TSM. Here you go. Here's TSM. You can see the same thing. Okay. This is why we want to buy that implied volatility. We want to buy that premium when it's down here because we know it's going to do this, and why we want to sell it when it's up here because we know it's going to do this. Sanaz, I think you wanted to look at NVIDIA. We'll look at NVIDIA. Here you go. Okay, Anthony wants to look at Amazon. You can look at any stock, any ETF, any index you want. You will see volatility always mean reverting. All right, Clive. Probably would have been easier if you just asked your question again, but let me. Okay, at what point is the amount for Vega in extrinsic value determined? Okay, Vega doesn't have to do with the extrinsic value, Clive. The implied volatility does. Now, it's kind of this vicious circle, if you will, because Vega tells us how much the value of that option changes as implied volatility changes. So just because an option has, let's say, a dollar Vega versus 30 cents is not a great indicator to me of extrinsic value. However, if you think of which options have higher Vega, okay, as we've discussed, which options have higher Vega? Anybody? Which options have higher Vega? Not necessarily, Clive. No, that's not true. Not the ones with high IV. Anybody else? Which options have higher Vega? Not puts. Puts and calls, Doug, have the exact same Vega. Okay. Bobby's got it right. At the money options have the highest Vega. What about timing? What about timing? Bingo, Sanaz. The longer you go out in time, the higher the Vega is. Well, if I see an option comparatively, okay, in the same stock that's got a 40 Vega versus a dollar and a half Vega, I'm going to know there's more extrinsic value in the option that has the dollar and a half Vega because it's got to be longer out in time. Exactly, Alan. Okay? Does that make sense? But you just because an option has a high implied volatility doesn't mean the Vega is high. Because if we have an option expiring today or tomorrow, here, let me show you an example. Let me show you an example here. Let's take a real high volatility stock. Here's Ionic. Okay. Here's options expiring today. Look at the implied vol here. I mean, almost immeasurable, like 200, 300, right? Something ungodly expensive compared to what we normally look at 40, 50, 60, right? So really, really expensive implied vol, but what's the Vega? Negligible, almost zero, almost zero. Do you see that, Clive? I'm hoping this helps you out. Okay, wonderful, wonderful. All right, guys, last one for the week. Last one for the week. Let's give it a whirl. And the winner is, are we going to have John or Mark or Harris? Mark Cronister are you here? Bingo. Nicely done, sir. Okay, I just posted in the chat, which thankfully I could do today. I posted in the chat the email address to send me your vitals. There we go. Mike, you are on the hop. I love these new messages that are coming across the screen here. Wow, this new platform we're using. Woo! We're in the 20th century. All right. All right, everybody. I hope this was helpful. Again, I really like to break these concepts down into a manner where you can kind of close your eyes and visualize how something happens rather than just knowing it by rote. All right, everybody, smash, 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 smash the like. Please smash the like. Awesome. All right, everybody, have a wonderful weekend. Hopefully, the football game tonight is going to be as good as that game was last night because that was phenomenal. I didn't have a dog in the hunt. Notre Dame, in fact, beat my Indiana Hoosiers, but what a great game that was. Let's hope tonight's game is just as good. All right, everybody, have an amazing weekend. Appreciate all of you. Take care, everyone.